Profit from the coming crash. This How to Protect Your Assets and Profit from a Market Crash video is brought to you by DynastyWealth.com. Michael Markowski, who has 40 years of experience, conducted the research that is contained in this video. He was named by Fortune magazine as one of its 50 greatest investors. Michael predicted the collapses of Lehman, Bear Stearns, and Merrill Lynch in his Equities magazine column 1 year before Lehman went bankrupt. Michael specializes in identifying potential crashes, startup companies, and digital companies that have 100 times return on investment potential. Here is Michael's September 2007 article in which he warned his readers to sell all of their holdings in U.S.'s 5 largest brokers, including Lehman, Bear Stearns, and Merrill Lynch 1 year before Lehman went bankrupt. He said, "I believe that there will be a day of reckoning. It will be sooner rather than later, and that day will be ugly for the 5 largest brokers." This 1950 through 2018 chart depicts the 3 lowest dividend yields for the S&P 500 since 1870. The January 2018 yield of 1.7% was second only to the yield of the S&P 500 before the dot-com crash. This chart depicts the stock market's bubbles from 2003 to 2018. The gigantic bubble on the far right was far bigger than the Lehman bubble prior to Mr. Trump's being elected. It has grown substantially larger. We recommend that you watch the 5 Bubbles video, which explains why this bubble and others are so dangerous. Gold does not protect against crashes. Gold declined by 12% and 17% respectively during the dot-com and Lehman crashes. Broad diversification does not protect against crashes, recessions, and depressions. Whenever a market crashes by 40 to 50%, all stocks decline, and portfolios, mutual funds, and retirement plans that have stocks in them decline together and significantly. The priority of the 90-10 crash protection strategy is return of capital instead of return on capital. To deploy a 90-10 strategy, one invests 90% of their liquid assets into government-guaranteed bonds and 10% into a diversified portfolio of venture capital investment opportunities. Under the 90-10 crash protection strategy, 90% of all liquid assets are invested in the notes of a government which has a credit rating of AA+ or higher. To reduce market risk, the notes should have maturities of 5 years or less. The U.S. is one of 17 of the world's 200 countries which have the highest credit rating. The highest rated 17 of the world's 200 countries with the highest credit ratings have a track record for being able to collect taxes from their citizens to pay off their debts during tough economic times. The U.S. is a good example. Since the U.S. has never defaulted on its bonds throughout its entire history, if need be, it will raise tax rates on its citizens to pay off its debts. After the crash of 1929, the highest tax rate went from 26% in 1929 to 80% in 1936 and ranged from 80% to 93% until 1964. Under the 90-10 crash protection strategy, the remaining 10% of the liquid assets are to be invested into a diversified portfolio that has the potential to increase by 300% in 5 years or less. The portfolio would include some or all of the following: venture capital, startups, stocks under $10 per share. Since crashes coincide with economic contractions and recessions, small companies have inherent advantages over large companies. A company with $5 million in revenue can easily double to $10 million in a difficult economic environment, whereas a company with $500 million in revenue cannot. From 1945 through 2007, small stocks, as depicted in the dark green on this chart, consistently outperformed large stocks for the first 3 years after all recessions ended. Mr. Markowski, Dynasty Wealth's Director of Research, specializes in finding startup investing opportunities which have the potential to multiply by 10 times or more within 5 years. 1,000 invested into these well-known companies when they were startups increased to as little as $1.6 million and as much as $20 million. Projections are for the number of apps in the App Store to increase by approximately 2 million from 2.93 million at the end of 2016 to 5.06 million at the end of 2020. The opportunities to invest into apps to deploy a 90-10 crash protection strategy will remain abundant. Here are some other emerging industries that are now growing exponentially, which will provide plenty of additional opportunities. They include virtual reality, Internet of Things, artificial intelligence, social media advertising, social investing communities, online and mobile games and gaming. 100,000 deployed in a 90-10 crash protection strategy has the potential to be valued for 130,000 in 5 years with zero risk. The $90,000 invested in Treasury bonds along with the interest income would be valued for the original amount of $100,000. Assuming that the $10,000 invested into venture capital triples, it would be valued for $30,000. The annual rate of return for both investments combined would be 6%. Financial advisors will not recommend crash protection strategies. The 90-10 would result in the advisor losing 90% of their management fees since it alleviates the need for the client's funds to be managed. Additionally, the advisor will not make recommendations for the 10% since they become criminally liable for doing so under Dodd-Frank. We highly recommend that you view the Digital Economy Transformation Providing 1,000 Times Return on Investment Opportunities video. It provides details as to why the transformation of the economy to digital from industrial or brick and mortar is providing opportunities to build a diversified portfolio with 100 to 1,000 times potential in 5 years or less. Scroll down below for access and click the button to receive a link to the video.